What's up, guys? It's Rob here, and today we need to talk about market crashes and how to make money during them because I know a lot of people are getting worried looking at the stock market, seeing that it's down large percentages, and are wanting to protect their portfolios. And I'm also going to show you a trade that I took this morning where I actually made some money off of the market crash. So, first of all, let's take a look at my account, right? I just recently made $331 this morning doing a trade, and I'm going to show you guys how I identified this trade as well as some other means that you can use to make money during market crashes. I made about 331 bucks on that. So let me run you through that real quick before I actually get into explaining how you can start making money during market crashes. Now, let's look at SPY and just see what's going on with it first of all. So SPY, I had noticed, was dropping quite a bit, and I actually made a video explaining this big drop that we saw. It was because of the Evergrande crisis, and we were seeing a bit of a rebound when I released that video. However, I was expecting us to see another drop because I thought that the rebound was a bit premature, that a lot of the fears about the Evergrande crisis had not quite been quelled, and that we would likely see another drop. Now, I ended up identifying for the target of my trade the inverse of QQQ right here. And QQQ, for those of you who don't know, is basically an ETF very similar to the S&P, but it tracks mostly tech companies. And I thought the tech companies might be getting hit especially hard because they tend to be a bit more volatile than the market as a whole. Now, QQQ, you can see, is making new lows today as opposed to what it was doing during the initial stages of the crash. Now, what I ended up doing, because I do not want to short QQQ, I think shorting is very risky. I do not want to buy puts on QQQ, especially near-term puts, because those often lose value very quickly, very rapidly, due to changes in implied volatility. And if there was a big movement upwards in QQQ, then I could be risking quite a bit of capital, more than I'm willing to. So what I ended up doing was going to SQQQ, which is an ETF that tracks the inverse of QQQ, right? It's a ETF that tracks the inverse with a 3 times leverage on QQQ. So what I ended up doing was, if you look back 10 days ago, around here, I ended up taking a position of around, I think, 7 grand I put into this, and I was having a pretty tight stop loss because if you actually looked at that yearly chart, you can see that this stock does drop dramatically, typically just, because QQQ itself goes up dramatically. So SQQQ is an inverse leveraged ETF that I was trading, and I bought in around 770, around maybe 775 on this little pump, and I was holding with the intent of selling at a pretty tight level, right? Because oftentimes, these market crashes in today's market where there's so much money flowing around, you don't know how low they're going to go. However, I was fairly confident that we were going to be going lower, and thus that SQQ would be moving up. So I ended up selling around the beginning of the day for 815 or 818 at one point. I think I did 2 orders where I got out. One was 817 and one was 815 right there. So yeah, there were a couple of exit points that I had earlier in the morning. I saw that we were up massively during after hours and pre-market, and I decided to get out for a nice $300 profit. Now, the reason I was able to identify this, if you look at the QQQ chart, is because of a pattern that I have recognized and talked about in other videos, where oftentimes you'll see we're dipping down very low with the markets, right? And then we actually make a little bit of a rebound. However, that is a fake rebound, right? It's a fake out. People think that we're going to be moving back up. And I believe that maybe institutions oftentimes push us up in an attempt to get people more confident in the market so that they can unload their shares. That's one of my suspicions, right? But then you see that we are dipping down quite a bit today. So ways that you can make money off the market, right? There are a couple that we've already mentioned. Shorting, I'm not a big fan of. I think it's very risky because you're basically taking on unlimited risk. Say you were shorting QQQ around this level. Well, sure, you would have made money because it did end up going down. However, you were taking incredible risk that if this thing ended up shooting up, well, when you're shorting, there's no limit on how much you can lose. You could lose an infinite percentage of your money, theoretically, right? Obviously, it'd be very difficult for this thing to just shoot up dramatically and more than double in a short period of time. But, it's theoretically possible, and so I'm not a big fan of shorting. You could also have traded some options. You could have looked at the puts. You could have maybe looked at a strike date that was a couple months out and bought some puts on it. That's always a way to go. I'm not the biggest fan of it because options contracts can lose their value dramatically, right? They can change very quickly in value, both to the upside and to the downside. So I'm not as big a fan of that. What I like about SQQQ is while it does have some pretty dramatic movements, they tend to be a bit more contained and controlled than other options that you have out there. If you're literally just trading options, it's a bit more risky, in my opinion, than just buying some shares of SQQ. You're also protecting your downside. I mean, you know it's not going to go to zero because will adjust the price as it starts getting lower and lower. Eventually, you'll lose most of your money if you just keep holding this indefinitely because it is leveraged and it is somewhat tracking options. But I like this stock as a way to make some short-term gains on short-term downtrend of the overall markets. Now, something else that a lot of traders don't think about, a great way that you can actually make money with options when there is market volatility is by looking at the VIX. Now, the VIX is not a traditional stock. It's actually a volatility index. For those of you who haven't heard of it, it's a volatility index, and it's basically calculated by looking at overall market volatility based off of the option premiums in far out of the money puts and calls. So it's kind of a complex calculation that I can't really get into here. But basically, this thing tracks the volatility in the overall market. So you'll see that there are oftentimes very high spike ups in the VIX price. And if we actually look, let's take a look at SPY, which is what this is tracking, and kind of compare the two so that you can get an idea of why the VIX moves up when it does. So if you look at SPY over the past couple of months, you can see that the VIX has had some spikes exactly correlating with when the SPY moves down. And if you look at the VIX right here, you can see the date is 6/18. So 6/18 is when the VIX was moving up, and that actually correlates, if we scroll back over here, to when the S&P on 6/18 was taking a massive dip. So the VIX moves up when the S&P moves down. That's basically the idea, because when the S&P is moving down, people get very nervous. They think that there's a market crash, and that increases volatility in the markets, right? So this pump up in the VIX 719 correlates perfectly with this downward spike in the SPY. So you can basically use the VIX to trade off of SPY. And if you actually look, I will show you on this screen right here that if you look at the past 2 years, the VIX had a massive run up. And this actually correlated with when COVID was hitting. People were very worried about the market. And so the VIX became an extremely valuable indicator, right? It became worth much more than it currently was at the time. It was around $15, and it shot up all the way to 85. Now, you can't actually buy and sell this, right? If you try to buy any of the VIX, it's not tradable. However, what you can do is go to trade, and you can look at the options for the VIX, which actually do have the potential to give you some fairly massive returns, because if you're looking from 15 to 85, obviously we're not going to see anything that big unless something really dramatic happens. But even from where we were just yesterday, around 17 or $18 to $24, that's a fairly significant change in price. It's 29% shift in the price. And you guys know options are very volatile already. So this actually is a situation in which I look at the VIX and I say the options and the potential for the options to go up in value massively and dramatically outweighs almost the risk of losing a lot of premium on those options. Because if you look at the VIX, you can see it does tend to move down, but it's not nearly as dramatic as how the market tends to move up. You can see that we've just been shooting up, and the VIX actually hasn't just been shooting down, right? I mean, it kind of has, but not really, right? We were trading around probably an average of like $34, and over the couple of months it went to 17. So it did decrease in price 50%, but the market has really just been steadily shooting up. And what's important to note about the VIX is that you will see these massive spike ups in price fairly frequently, because every time there's a little dip in the SPY, all of these little dips that you're seeing here are causing massive upticks in the price of the VIX. So I do think that the VIX is a pretty good way of making some money off the markets. I have not yet actually traded this myself. I likely will in the future. I'm not sure about this current crash, right? Because this current crash, it's not confirmed whether or not we're actually going to be going much further. We are hitting a bit of a support level right here, you can see. And I'm not sure if we're really going to be going too much further. I mean, there's the potential that we will, but the VIX tends to price things in fairly rapidly, right? So if we're not moving down in a dramatic way day after day, then the VIX isn't necessarily the best way to actually capitalize on market downturns, because the VIX is really great if you can catch the downturn before it actually turns into a downturn. Like if you got in yesterday, then you would have been up 29% if you were holding the VIX, but if you were holding options, you would have been up quite a bit more than that. So the VIX, in my opinion, is great for when you see a big uptick in the market and you think that that uptick isn't justified, just like what we were looking at a couple of days ago when we were coming off of this crash. It looked like we were rebounding and rallying. However, if you were able to identify that as a period where we were likely going to fall off of, then that was a great opportunity to take advantage of it with the VIX. So that's how you guys can potentially profit off of these market crashes, there are a couple of ways we've talked about options. I really don't recommend shorting. I don't think that's a great idea. The VIX and SQQQ. So those are all a couple of things that you guys can do. Obviously, this isn't financial advice. I'm not recommending that you do any of those specifically. You should do your own research into them and look into them and definitely learn more. Don't just take my word for it. You probably want to research a little bit more about how they work and how they're calculated. But other than that, guys, I hope you enjoyed the video. Have a great day. I'll see you in the next one. Bye.